Ben says, can't predict the market, but what option trades are best for a declining market? Ben, that is really tough. I would go with the standards. Bear call credit spreads, possibly calendar put spreads, and bear put debit spreads. Why complicate it beyond that? Let's take a look. Let's go to other strategies here. Let's just do a rundown. I'm just going to select all bearish positions, standard bearish positions. What have we got? Bear call credit, naked call, buying puts, calendar put spreads, bear put debit, married call position, covered put, and the short collar. Okay. Well, let me change. I want to change the configuration here. I'm going to move short collar up real quick. And I'm going to move married call up real quick. There's nothing wrong with these. Not naked call. I'm sorry, folks. Married call. There we go. And covered put, I should probably put at the very, very top, but that's okay. So what are we talking about here? Why am I putting these three strategies up at the top or in the first bar that we're looking at? These positions, Ben, are the bearish positions that are exactly opposite of the standard positions you'd think of. Level 1 trading, covered call, maybe a collar position where you're buying stock, selling calls you would in a covered call, but buying a put. Do you have a controlled risk to the downside and still collecting premium? Long collar, profitable strategy. Or the cash secured naked put that we talked about before. These are the reverses, meaning what? If I do a covered put position, it's the reverse of a covered call. Instead of buying stock and selling a call against it, I'm shorting stock and selling a put against the position to cover my obligation if the stock falls. So the stock falls, what happens? I get assigned on the naked put, which covers, now that I'm buying, my short sale stock position. Short collar would be selling the stock, selling a put against the position, and buying a call option to control risk if the stock goes to the upside in the opposite direction. Similar to standard collar. And the married call, opposite of the married put we just talked about for Robert, shorting the stock and buying a call against it to control the upside if the stock goes in the opposite direction. Why do I want to break these out first? Well, number one, what do all three of these positions have in common? Well, just like the covered call, the long collar, and the married put that involve buying stock, all three of these involve shorting stock positions. You'd want to check with your broker. What are your margin requirements for shorting stock? What are your requirements for shorting stock in your portfolio? Can you even do it? If you can't short the stock in a retirement account portfolio, you can't even use these three in that case. But if you're okay with the margin requirements for them, you'd expect the same things. What do I mean by that? Covered put in a down market, expect the same returns and risks as you would with a covered call. Maybe a 1 to 1.5% return on the downside on the covered put position. If you're signed on that short put, and you want to set a stop at about 7%. Short collar, well, the risk's already taken care of for you, but you're shorting stock, selling the put, buying a higher strike call that's out of the money. So you might still be looking at maybe a 2%, 2.5% return for a 30-day out trade with a risk of 4 or 5% if the stock goes in the wrong direction against you. And the married call again, shorting shares of stock, buying, if I did it the opposite of the married put, buying a far out in time call, 150 to 160 days out in time, to keep the losses to 6 or 7% on a short stock position. However, this I would never necessarily recommend. I would never recommend doing a married call position opposite of how we approach the married put with a far out call that's in the money to control risk to single digits. Why? Because most bearish markets don't even last near that long. Remember the last two Septembers, Ben, what did we have? The last two Septembers, 2020 and 2021, we saw about a 9% and 10% decrease in the broad market indicators in SPY, QQQ, NASDAQ, whatever, IWM, Russell 2000, what have you. And then shortly after that, a month or two later, it was right back to where it was. bearish markets are usually not that long term. Now, if you're expecting that things are going to change, that inflation, interest rates are going to increase, we're looking at maybe a 5 to 6%. Hey, you can't predict the market. That was the first portion of your comment, Ben. But if you're expecting markets to be down 5 to 6 months in a row, maybe that approach would work out better for you. But most of the time, what we've seen is that the big corrections, 7, 8, 10%, 12%, usually happen very quickly over a 3 or 4 week period. And then 1 or 2 months later, they're back to where they were, if not less. In the recent markets we've had, I know that's not the grand scope, but most corrections, 10, 12%, usually start to come back after that bottom. They usually happen 3 to 4 week period. That quick decline. It's not 5 to 6 months. Very rarely is. That being said, let's move on to some of our other bearish positions. So these three, same expectations you might have for a married put, long collar, or a covered call, or what you would have there as far as target returns, what you'd look for range in or out of the money, and so forth. Naked call, I would never suggest. I have investors that use power options to do it. I have investors that ask me about management techniques that are power option subscribers. I've never traded this personally. Yes, you have a lot of risk on a naked put. Yes, you have a lot of risk on a covered call position to the downside if the stock really tanks against you. You have infinite risk to the upside here on a naked call. You're selling a call without anything to protect it. It's a naked call position, causes a high margin requirement. Technically, by definition, you have infinite risk to the upside. But if you guys ever find the stock that goes up to infinity, let me know about it because I'd like to get in on it with you. You can control the risks, you can manage it. But naked calls are always at level 4. And in some brokers, they have a different distinction of level 5, I've heard. More restricted accounts, level 4, level 5 requirements to trade the naked call position. If you feel the market's going to be going down, Ben, bearish in the next 3 to 4 week period, a 1 month period, your focus is going to be on those last 3. It's going to be on bear call credit spreads, opposite of the bull put, selling an out of the money call, buying a further out of the money call position. Same risk with the bull puts, meaning that you shouldn't be putting more than 10 to 15% of your total portfolio into the credit spreads, because if you're wrong and the market goes up, you're going to see those 40, 50, 60% losses on those positions. You're going to have to close them out. Okay? Leverage spread trades involve risk. Bear put debit is a parity trade to the bear call credit, has a similar risk reward profile, just like the bull call debit, Ben, has a similar risk reward profile to the bull put credit spread. But the benefit of the debit spreads is that in a bear call, just like in the bull put, I'm probably looking 1, 2 weeks out in time, out of the money, looking for that good probability, that good percentage return I want. With the debit spreads, what a lot of investors tend to do, bull call debits and bear put debits, they might consider doing an at the money spread, meaning we were talking about NVIDIA at 330. So if I was bearish on NVIDIA, what I might do is sell a 325 put and buy a 335 for a debit of maybe $5 or $6. And if I'm right and the stock falls below 325 and I get the 10 points back, I'm looking at closer to a 1-to-1 risk reward ratio, but I have a smaller probability of seeing that maximum success on the position with these sort of at or out of the money debit spreads. But this is also not 1 week out in time what I'm talking about. This is not 2 weeks out in time. This is 50 days, 60 days out in time to give yourself more time for the stock to move in your direction, but keeping a closer to a 1-to-1 risk reward ratio on the position. And you'd probably look to close it as always if you got near that 50% loss of the expected maximum risk on the position, Ben, in those cases. And then the calendar puts, just like a calendar call spread, what some people call the poor man's covered call. Instead of buying the stock and paying the full capital, Ben, to sell the call against it that's covered, to do the covered call position, 1, 2, 3%, depending if you're going monthly or weekly expectation. I might buy an in the money call 2, 3, 4 months out in time and still sell that same near-term call against it 1 week out or 2 weeks out. I got a leverage position. I paid 1/10 the cost. Calendar put is a similar approach, just reversed. I might be buying a put 6 months out, 5 months out, 3 months out, whatever your preference is, and then selling a lower strike put shorter term. That if I'm bearish on the market long term, what I'm looking to do is pay for some of the cost basis of this position by selling the near-term put, and I still have a max potential return in double digits in those first 20, 30, 40 days, whatever it is, out in time. And if the market starts to turn, I can just sell to close the put, close the short put if I still have one open. Hopefully I'm still at a profitable level, and now I can go back to the bullish positions. Why am I not talking about buying puts? Why am I haven't even discussed put buying? Because depending on where volatility is, we've got a lot of webinars on this that to talk about the stock insurance versus portfolio insurance, how to insure your portfolio using SPY puts. In general, I just had a coaching session today with a gentleman who's been trading for 5 years. He let me know all the strategies he's been trading over the last 5 years. And of course, at the end, he says, now I've traded long calls and long puts, but I've never been successful. Only about a 52 or 53% success rate, a little bit more than break even, but not great. And honestly, that's been my experience since I've started trading options back in 2005, 2006. I've never had a great track record with buying calls or buying puts, whether it's the volatility that gets you, whether it's the market movement doesn't happen in the anticipation in the time frame that you wanted to, or it does move down to the time frame you want, but you needed a 5 or 6% move to profit on the put, and you only got a 3% move, and now you're looking at a loss on the position. There's a lot more involved with just buying puts. And it's also the fact that you miss it sometimes quickly. And what do I mean by that? We talked about SPY. We talked about the market downturn in the last 2 Septembers, Ben. Let's just take a look here. And this is where the timing is key. So that's the September series. Check that out. From about here to here is that September decline. And it started to, I've stopped there because it started to rally back up. Yeah, I had a little hiccup here. But let's say I started to see the market sentiment indicator showing sell signals, which we did around this time. And we're up here at this high level here, new high at 450-ish. That's probably about, yeah, I think it was about 450-ish in that case. And I say to myself, okay, I want to buy puts on SPY. I'm going to buy the 440 put in this case. And there's a lot of news going on. There's a lot of things going on. And I'm going to buy it 1 month out to October, which is right about here. Okay. But that 440 put 1 month out in time was $9.45. When the stock fell here with only 14 days left to go, and we're at 430, we're probably looking at a price at $11, maybe $12. That's great. Okay, don't get me wrong, you've profited. But even at $12, that's less than a 30% return. This idea of the 300% returns with buying calls and buying puts, 200% returns, you can see 400% returns in 7 days. You need a much bigger movement on a much more volatile stock to see those returns. And what are we talking about here in that range with those types of volatile stocks? That implied volatility is already factored in. If there's a biotech stock trading at 450 and it has an implied volatility of 1.3 that we saw on, it wasn't Riot, it was the other one that came up in that search when we did. It wasn't maybe it was Blockchain or Riot, or maybe it was Mara. I think it was Mara. There's a 1.3. You know what that 440 put would be worth? Probably closer to $35 per contract, $42 per contract, somewhere in that range. 4 to 5 times, okay, 3 to 4 times the price that you'd see on something like SPY. What does that mean? If the movement happens because there is an event coming up, even with that steep decline, if there was an event coming up that could cause that, a patent lawsuit, FDA approval, Ben, something along those lines, once that event happens, that implied volatility is going to drop, which is going to affect your option price in that case. And a lot of times that's what happens to the call buyers. They buy something, a call on Lucid, which we saw take off, or on Mara, and it goes the opposite direction, but they paid into high implied volatility. They not only have the stock going in the wrong direction, now they get implied volatility crush where that 1.3 volatility is cut by more than half. It might be 0.5. Now there's no premium anywhere near what they need to repair the position that they're taking a loss on. buying puts and buying calls, in my opinion, takes a little bit more thought. And you need to have the timing right, because you can even guess the timing right, but if you overpay into that long put position or the long call position, but we're talking about bearish here, so the long put position, if you overpay into it and you only see a 5-6% move in a 30-day time period, you might have a profit, but you're not going to be near some of those promised profits you talked about, that 200%, 300% return that you see advertised in some other options trading firms and things along those lines. So again, the covered put, the short collar, and the married call, they would be considered relatively conservative because protection is in place. And you know the return you're looking for here, like a covered call, 1 to 2%. Short collar, you're shorting stock, selling a put and buying a call. So you've got that similar, maybe 2% return with a 4% maximum loss on the position, but you have to short the stock. More common approach, I feel, for retail investors when they're going into it is they're going to be looking at bear call credits, bear put debits, calendar put spreads, the vertical and the calendar spreads, to take advantage of a 2 to 3 week market downturn without exposing themselves too much. And yes, if you have a larger expectation and you're looking at positions, maybe just SPY that's not too volatile, you find good prices, buying a put to hedge another portion of your portfolio or to profit good percentages, 20, 30, 40%, with a 2 to 3 week downturn of 8 or 9%, that might be pretty good. Some positions an 8 or 9% decrease. If you buy an out of the money put speculating, that's only 3 or 4% of the money, now you might see a 40, 50, 60% return on that position. But to see those really high advertised returns, 200%, 330%, you really need to see a much bigger movement. We're talking 12, 15% in the underlying security. And if it's already volatile to begin with, has high IV when you buy into the position band, now you're talking more along the lines of probably a 15 to 20, 25% movement one direction or the other to profit on your long put or your long call, depending on which direction you chose.